A lot of people are now thinking recession, and you make that point, and that high gas prices can cause a recession. Is it possible for inflation itself to cause a recession, even if the Fed doesn't overshoot on raising rates? And because I always think of it the other way. Inflation goes up, the Fed tightens, rates go up, people pull in their horns, they can't get financing, we get a recession. But could the Fed just sit where it is and inflation gets so bad that consumers stop spending?
It's possible. And I would argue that inflation is the main driver of the recession worries that we've seen this year. And a lot of it has been driven by worries about the Fed. You know, we'll see at 8:30 what the latest print looks like. But either way, inflation is the biggest risk to markets right now. And it's why investors have sold stocks so aggressively throughout the year. And it's driven this huge rotation in the stock market. It all comes down to inflation and worries about inflation. And, you know, we saw yesterday stocks had their worst day in 3 weeks ahead of this inflation report. So it shows you that this is really top of mind.
But because of the 10-year, and that's where we get back to chicken and egg type discussion. Now, yesterday, the 10-year went back above 3%. I was thinking yesterday, if we knew the terminal rate, that's the big question in everyone's mind. We know what, because it's still low. Anybody can deal with 3%. We can deal with 4% probably long term. We just worry about that Volcker type, scenario where you just keep going higher and higher and nothing cools things off. But that all entails the Fed raising interest rates. You think it can happen just from inflation itself?
Look, we don't know. And I think it comes down to inflation is a concern we have not dealt with in decades. Like, this is so different from the market environment that we had over the past decade. And to your point on treasury yields, part of the reason it is such a risk is that it does shape the path of treasury yields. And that's dealt a blow to one of the high flyers of the past decade and just turn the stock market upside down when you think about the tech underperformance relative to other parts of the market that we see.
Well, you point out there are certain similarities. Money was pretty cheap back in 1999 too, and technology got very popular and story stocks and beloved names in tech. We were forewarned that higher yields would hurt tech much more than most other industries because of the multiples, and now it's happening. And I don't know why we're so surprised that was the end result. We've been saying this for a year, I think.
Right, but the trade worked so well for so long that people kept clinging to it. And what's interesting is that even after this recent underperformance, with tech off to the worst year in more than 2 decades, tech is still, near a record percentage of the S&P 500. So it's really hard to let go of the trades that worked, even though, growth is underperforming value by the biggest margin since the dot-com bubble burst. And yes, I too was struck by these comparisons with the dot-com bust, where people were saying it kind of seems like we're exiting the bubble, or maybe it hasn't fully unraveled yet. But that's the time period that this has reminded a lot of investors of.